Okay, let's get into the stock market technical analysis. We've got the Fed on deck. They're coming out in the next couple hours and very likely going to announce a quarter point rate cut to the short-term interest rates. So we'll dive into that. Let's look at some charts. If you guys are finding value, please drop me a thumbs up. If you're interested in getting additional market insights and charts and trade ideas, check out the private member group. Link in the description below on that. It's super cheap and you can cancel anytime. It is. It's also the best way for me to post active trades when the markets are moving very quickly. Recently, the markets have been pretty slow, so we've been just grinding higher with really low volatility. So I'm not as active in the private member group when we have that kind of market. However, with the Fed on deck, with interest rates starting to move around, I'm expecting volatility to start to pick up, and then I'll be posting a lot more updates in there. Okay, triple Qs. We have the Fed on deck. We did have this hourly. This is an hourly chart. We did have this little breakdown today. Again, this is just a short-term breakdown. I think we could drift after the Fed. I think we could come down to about 584-ish, maybe right after that announcement, and then that's likely where the market will probably where the buyers will step in. I don't think we're going too much lower today. I mean, again, the Fed it's almost pretty much guaranteed the Fed's going to do a quarter point cut. The market's expecting it. So any kind of volatility you see after that announcement, we really want to see how the market trades tomorrow, and what do the big institutions do with large positions after the Fed. All right, when they can actually move their positions when they have liquidity. Okay, so 584, that's probably would be the downside, and that's about it on the triple Qs for today. On the daily chart, you can see we have a new divergent high. All right, we've been building negative divergence. That's a divergent high, the price action right there. Right ahead of the Fed, we've made a new divergent high. See momentum, it's just dropping off. It's just continued to drop off, and that is, the condition of divergence remains. All right, it's been there for a while, and it remains intact. So very likely we're going to get sold into this divergent high. Will be sold into probably Thursday and Friday potentially, or next week. We'll see. And that's it. There's no real sell signals except for this very short-term sell signal. That is a sell signal on the hourly chart, and it could be the start of a more meaningful pullback. We don't have a sell signal yet on the daily chart because we haven't had a daily close. And really what you want to see is start to take out some of these support levels. All right, the buyers keep stepping in at support. So you take that out, and then, you're probably going to go down. And I think you probably go down and test these lows again down here at 559. All right, we've already tested that twice. You take that out, we're gonna start going down to lower levels. But first things first, we've got the Fed on deck, obviously. When I go to the weekly chart on triple Qs, you can see the thing that really stands out to me is this big weekly divergence that's been building really since. You had the first divergent high we had was right in here, about in February. That's where we started building weekly divergence, and that has remained intact. So all of this price action here on the weekly chart is divergent highs, and it is that hasn't changed. Nothing has changed there. If you go and look at on the weekly chart, when the last time we started to have big weekly divergence, it's really right here. You can see the weekly divergence here. We basically were building weekly divergence back in 2022. Well, really 2021. That built for a while, and then once it finally broke, you got a big drawdown, about a 36% drawdown in the triple Qs for all of 2022. So that's kind of where we're at. We're basically, from what I can tell, we're kind of in this area where we're likely going to get a decent sized drawdown, and that's just showing on the weekly chart. And so here we are. And equally, we've actually already broken. If you look at the weekly, this was the uptrend line there. we broke that. So there's your first breakdown, and we've been back testing. All right, we've been back testing on the weekly chart for months now. But that's it. It's just grinding higher and back testing. We need to see a rejection. A clean and clear weekly rejection will indicate that the back testing is likely finished, and we're now going to start to head lower. I can easily see us taking out these lows right here, all right, and making a new lower low, probably going down to 350, all right, on the weekly chart. Now that's going to take time. It's going to take months. You know, it could take half a year or so to get down there. We'll see. But again, we have broken that trend. We're back testing on the weekly. We have negative divergence. It looks very similar to the setup that we had back in 2022. All right, so we'll see if that plays out. Okay, flipping back over to gold. Here's the gold miners, GDX. Still holding trend. You've got this uptrend line here on the daily, still holding that trend. I don't see any real negative divergence on the daily chart. So momentum is relatively strong. There's no reason to short this thing right now. I think we can easily get a pullback soon, but I don't see anything that I'd want to build a case to short GDX right now on the daily chart. Nvidia, I think, is key to the market. Again, most of the market has been going up primarily due to the large cap tech stocks and the weighting that they have on the indices. So Nvidia is kind of key to that. Negative divergence remains on Nvidia. You can see we basically just extended that divergence. We've kind of topped out. We're building this sideways range, not really dropping, not really going up. So we need to take out, you take out resistance, which, is basically overhead here. Let me kind of mark that out. There's resistance. It's about 183, and then support is about 160, 165. Whichever way you break is likely indicating the next tradable trend. The divergence tells me down, but it doesn't have to be. I mean, we can extend and maybe put in a new divergent high, maybe run up and rally and still keep the divergence. Momentum would move up, but you could still keep the negative divergence. So it's not divergence doesn't give us a reason to short. All right, we need to see breaks of support or rallies into resistance. As of right now, we're just sideways. So for me, there's really no trade here. It's just kind of wait and see what happens around key levels. A trade idea that was pointed out in the private member group yesterday is PNC, negative divergence. You have a trend line to follow. So we've got clean trend line. It broke yesterday. We got a sell signal right there on the break, and with the daily close below that trend line. Today, they're rallying it up and back testing. But again, this is price action taking place right ahead of the Fed. I think it's just literally algos trading, and we're just rallying right into resistance. So as of now, we have a sell signal until this trend line is recovered. This is a breakdown and a back test, and we're, if you want to wait for another clear rejection, a big red candle, that would be the conservative play. But we do have a break of trend as of yesterday. And I think we head down. First, I like this support level right here, 184.34. There's lots of reactions, big gap up from the past. Lots of reactions validating that. Look at that big candle right there, big kind of volume spike. And so I like that as support, pretty decent support right there. It's about 184.50. That's where I think this thing heads. And that would be a drop of about 9%, 9.5% from where we're at right now. Wheat, haven't covered wheat for a while. No change, no technical change, so there's not anything that's really jumping off the charts in terms of actionable, but it's still a constructive trade. We're still building. You can see here, wheat has been putting in a big bullish falling wedge, and it's been doing that for a couple years now. This wedge, so it's still a bullish chart. We also have big bullish divergence, so it's constructive. And if you really objectively look at it, if you've been buying at support, you're not really down all that much either. I was looking at this yesterday. You can see here, like if you bought at that support level there, which honestly, we didn't even know that was support at that point because we only had 2 data points. So you really wouldn't want to buy there, but you're down about 9% over the period of, basically a year. And then this level here, third reaction there. So, you don't have a support trend line until you have at least 3 data points. So we have 1, 2, now we have 3. So that validates a trend line. So basically this is support. And if you now have been buying at the support, you're actually slightly up or break even. So it's technically, not a bad trade. I mean, it's constructive to buy at support or on breaks of resistance. So again, I'm still a buyer on this. I like buying it down here on this trend line. I'd buy it there, and then obviously I'd buy it on a break of the top part of that wedge. And then the projected target for this thing, I've got the widest part of the wedge right about in here, and I've kind of measured that out, and I think the projected target's somewhere around $6, maybe a little bit less, but somewhere right in there would be the projected target. And that would be a rally from where we're at right now of about 40%. So that's kind of the long-term chart, the larger setup. Again, it's not going to make you money today, but still a very constructive chart for a potential long trade. Here's another trade idea, URI. We have negative divergence on the PPO and the RSI. And this is a daily chart. We've got, and this is an industrial stock. We've got lots of reactions to validate this this trend line. We have a bearish rising wedge just starting to crack. All right, it broke here a couple days ago. You can see there's your daily close below the trend line, and then it's just been back testing. We're waiting for the Fed. So what I would do on this, you could take a starter short. Again, I wouldn't take anything too heavy into the Fed. It just doesn't make any sense. Maybe a starter short, and you can add to it if you see a big rejection candle. Anything can happen. I mean, at the end of the day, we've broken down. It is a sell signal, but it's right ahead of the Fed, so they could recover this trend line after the Fed. So that's why nothing too large. Starter short would be probably the maximum, maybe 25% of a full position, something like that. And then you can always add to it. If you get a big red rejection candle, some sort of a big red, daily close rejection candle, that would be a sell signal as well, and I'd be looking to take that for a move down to about 820, 833, and then probably going to go down to hit the 200s, but again, that would be the first level of support. It's about 820, yeah, somewhere right in there, 827. Yeah, it's coming off this big breakout candle right there. Okay, interest rates. The Fed obviously is going to cut 25 basis points. If the Fed does not cut, and it's very, very low probability, but if they do not cut, I'd expect the market to pretty much plunge because the market has priced in a cut today, and I think they're even pricing in 3 more cuts this year or 2 more cuts this year. So that's kind of what's going on in the expectations. So if they don't cut, obviously the markets are going to tank. If they raise, the market will tank. Anything but a cut. All right. So that is, that's kind of that situation. So keep an eye on that. But obviously, it's super low probability that they're not going to cut. The Fed basically does exactly what the market's expecting. So that's it on that one. This is TYX, the long-term interest rates. Last time the Fed started cutting was back in September. So they started a cutting cycle right here. And you can see interest rates had been falling leading into that cutting cycle. And after they started those rate cuts, the long-term interest rates did nothing but trend higher. All right, went all the way up. So that's the Fed started cutting, interest rates went up. All right, so if that happens again, it's that could easily happen again. Then I think we're going to see interest rates pop back up to their highs and take those out. All right, take out those highs. And if you do take those highs out, which is about 5.16%. If I go to the weekly chart on the long bond, we haven't seen interest rates above those highs. If I just roll out, you can see, yeah, you haven't seen interest rates since 2007. All right. And we all know what happened, during that period of time in 2007, leading into the Great Recession, essentially. So, yeah, that would be interest rates that we haven't seen in almost 20 years. We haven't seen interest rates that high. And believe me, there's been a lot of bad investments, commercial real estate, a lot of bad investments that have been made where, like, you really wouldn't make that investment unless interest rates were at zero or near zero. So you have all these investments that people made when interest rates were at zero, and if you start seeing interest rates spiking above almost 20-year highs, a lot of those investments don't paper. They don't, they're not papering anymore. They're negative. They're underwater. And so the longer that kind of goes and the higher interest rates go, the more damage it's going to do. You're going to see things starting to kind of come down. So yeah, that's it. That's really what we've got going on. So I'm going to wrap the video up there, get it out, and we'll see what the Fed has to say. All right.